Okay, chapter 23, where we're talking about flexible budgets and standard costing systems. You might have noticed we skipped chapter 22, where we talked about master budgets, so feel free to look over that if you don't have any experience with budgets at all. But so the managers use budgets for planning and controlling. When we talk about the main functions of a manager, controlling is one of them. So we use it to plan how much stuff I'm going to need, how much money I'm going to need for that stuff, and then also to see how I did. I thought this is what I should be able to do it for, and how did I do with that? And a lot of you where you work are probably measured against budgets, so you probably have some familiarity with this. There's a static budget, which just says, here's how much we're going to do. There some other important terms in there are performance reporting, which we'll look at a little bit, which really just says how did we do compared to what we thought was going to happen. We need to look at variances. When we look at these performance reports and we were over budget or under budget, we want to know why. And then the other thing that we talk about in here is a flexible budget, which allows for different levels of production. So this would be an example of a static budget. And so as you can see here, here's what they were planning on, and then here were the actual results, and then this is the variance, which is really the main thing we're talking about in this chapter. Now, we can see here that their costs were more than they thought, or their costs were less than they thought they were going to be, even though they made more units than they thought they were going to be. So that's interesting there. And this doesn't give you the answers, but this will point you in the direction of knowing where to ask the right questions. Even if we performed better than we thought, we still want to look at that and figure out why. Is that something that we can keep doing? So I'll talk about the F is favorable and U is unfavorable. So those are important as well. We can see here that our fixed costs were more than we thought, and so we have an unfavorable budget here. We might not be anything we can do about that, but we at least want to look at that and figure out why. So a flexible budget, again, allows for different levels of production. So the main thing about this is it separates the variable cost from the fixed costs. And so in order to do this, you need the selling price per unit and the variable cost per unit. So again, this would be our contribution, our friend from chapter 21 there. Variable costs will be things like direct materials, direct labor, variable overhead, those types of things. And so we'll get all those things down to a per unit cost. The fixed costs will be things like mostly overhead, fixed overhead, manufacturing or selling administrative. And then we'll look at a relevant range, what we expect our volume to be in relation to our capacity and that sort of thing. So this would be an example of a flexible budget. So here's what I'm selling it for, and then these are my variable costs. And so if I sell 48,000 units, 50 or 52, here's what I think my budget's going to be. And this is going to be a lot more meaningful because this, in the other one, maybe my variable costs were more than I was expecting, but that's only because I made more than I thought I was going to do. So this is a little bit, this says, okay, 4 different levels of activity. What do I think my budget should be? So it's going to be easier for us to measure and see how we did. So this is an example of one of those. Mohi Incorporated manufactures travel locks. They sell the locks for $19 per lock. The variable cost is $9 per lock, and the budgeted fixed costs are $1,300 a month. So in this one, they've lumped all those different variable costs together. Production stuff, overhead stuff, all of it together. So if we were going to do a flexible budget, so the units, we said, what if they make 4,000 units, and what if they make 11,000 units? So my per unit cost, my sales revenue, is going to be $19 per lock. So if I sell 4,000 locks, 4,000 times 19 is $76,000. My variable cost is $9 a lock. So if I sell 4,000 locks, 4,000 times 9 is 36,000. So then my contribution margin would be the 76 minus the 36, or $40,000, minus my fixed costs, and we don't take fixed costs per unit. Those would be 13,000, and so that gives me an operating income of 27,000. If I were to produce 11,000 units, 11,000 times 19, my revenue would be up to 209. My variable cost would also go up, so 11,000 times 9 would be 99,000. So my contribution is 110. My fixed costs are still 13,000, and so my operating income would be 97,000. So that's how you would do a flexible budget. The important thing is to get all the information, to get that variable cost down, the per unit cost. That's once that's done, that's the hard work. So when we look at performance reportings, we're looking at variances. And again, it's a favorable variance if it increases operating income. So if revenue is higher than I expected, or if expenses are lower than I expected. And the opposite is true for an unfavorable variance. But rather, just calculating the variances is not enough. Managers want to know why a variance has occurred. So in order to do that, most companies will develop what we call standard costs and standard values for production. So it's the price or the quantity that is expected. Standard costs help managers in a number of ways. So it helps prepare budgets. It helps set the sales price. So if you think of it this way, when a customer says, I want this order, you can't wait until after you've produced it to see how much it costs you to tell them. You're bidding ahead of time, and so you have to give them an idea ahead of time of what that's going to cost. So that's what your standard costs are for. You can't wait until afterwards and then say, okay, here's how much it was. That's not how this is usually done. But this will help us set targets. It helps with performance standards. Here's how many shirts you should be making in an hour, that kind of thing. Most of us have to deal with that where we work. And this will also help us control costs. We can see if what we did was above standard, below standard, or right at what we expected. So in setting standards, we have two categories. We have cost standards and efficiency standards. So this is how much we paid for materials or labor or that kind of stuff. And over here is how much we used, okay? So how much material we used to make those shirts. Our standard says it should take half a yard per shirt. How much did we really use? And so that can be related to a variety of things, how skilled your workers are, how many defects are in the fabric, all that kind of stuff. Here's an example that they used, I think from the book. I can't remember what we're making here, but here's how much I expect to purchase for my direct materials, I guess paraffin, and then delivery and all that kind of stuff. So the cost per pound for paraffin in this example was $1.75 per pound. Here's how much I expect to send for wages, and I include taxes and benefits and all that kind of stuff. And so then I estimate my my overhead. I come up with like a predetermined overhead rate. Here's how much I expect to spend. Here's how many hours I expect to incur, and then I get a rate per hour. So when we look at these efficiency standards, the main way to do it is you time people. So this is the cost standards. Here's how much I expect to pay per pound, per hour, that kind of stuff. The efficiency standards are set by like benchmarking, timing people, seeing how many candles a person can make an hour on average, and that kind of stuff. And so you want to set standards that are challenging but realistic, for example. So once you put the two together, we've got this is kind of how the whole thing works. So over here we've got actual cost and actual quantity. So this is what we actually spent, and then this is standard at standard. So this is what we were expecting, and then the standard cost for actual quantity. So this is where I allow for different volumes. And so again, I don't want to know, if the cost was higher because I made more, that doesn't tell me anything. But when I use this one right here, this is what it should have been for that level of production, okay? So if I made more volume than I was expecting, this adjusts for that. So the difference between these two is a cost variance. The difference between these two is an efficiency variance. So, and then the whole thing is my variance. And so I will have direct material, direct labor, and variable overhead cost variances, and I will have direct material, direct labor, and variable overhead efficiency variances. So I'll have, for each thing, direct material, direct labor, and variable overhead, I have both a cost and an efficiency variance, and then I'll do some for my fixed costs as well. So I'll have a total of 8, but the first 3 there, they're all kind of variations on the same thing here. So a cost variance measures how much I paid versus how much I think I was going to pay, whether that's per hour, per pound, or per yard. And so I've got actual cost times the actual quantity, the difference between what I actually paid and what I should have paid, okay? So what I actually paid versus what I think I should have paid for this volume. And then you can see here I've got actual quantity here and actual quantity here, and so through the magic of algebra I can simplify that to this equation right here. And so I can use this equation to measure the cost variance for direct material, direct labor, or variable overhead. Efficiency variances are, if we look back at this little thing, here's my efficiency variances, the difference between the standard at actual and the standard standard. So I've got standard cost at actual quantity, standard cost at standard quantity, and I can simplify that right here to this formula. If I can, I will always use the shorter formula because fewer numbers means fewer chance for a mistake. But sometimes the way they give it to you, you kind of want the longer one. So, oops, that's not what I wanted to do. Let's go back to the pen. And so again, this is what you actually used, and this is what you should have used for that level of production. And we can do the same thing. Yeah, so that's for the variance. So let's let me break this video up. Well, let me try to keep going here and see if I can. No, I'm going to break this up. Sorry, just because some of these get so long, they're too hard to post. So let me pick up there in 1 second.